Every great empire believes it is the exception to history's rules. They look at the fallen Rome, Spain, Great Britain, and tell themselves, we are different. But history is not impressed by arrogance. It shows us, with ruthless precision, that every single global power falls the exact same way, through the erosion of its currency, driven by uncontrolled debt and the illusion of limitless spending. For the United States, the moment of reckoning is no longer a distant theoretical threat. It is playing out in the charts right now, and the Magnificent Seven just sent the loudest possible signal. This week's explosive earnings reports from the market giants, Apple, Amazon, Google, were not just good news for their shareholders. They were a powerful, undeniable indicator of deep, systemic liquidity flowing back into the system, painting a vivid contrast against the backdrop of the government's $38 trillion debt burden. We saw Apple report surging demand for the iPhone 17, signaling robust consumer confidence and a global supply chain that is momentarily behaving. Apple is the ultimate economic barometer, and when the consumer is buying premium devices, they feel financially secure. Then there is Amazon Web Services, or AWS, which grew at 20% year over year, hitting a stunning $33 billion. This is the fastest growth pace since 2022, telling us that the corporate world is once again investing heavily. When the two most critical barometers, the consumer and the corporation, signal a go simultaneously, you have the foundational elements for a powerful market surge. But here is the so what factor that connects this to the empires of the past. This surge in market liquidity and optimism is happening immediately after the Federal Reserve, or the Fed, the central bank of the United States, announced its first quarter-point rate cut in 2 years. When the Fed begins to cut rates, it signals two things: trouble on the horizon for the broader economy, and a return to easier money. The market is taking the easy money and running with it, initiating what appears to be the quiet beginning of a major bull market rally into November and December. Yet we cannot ignore the chilling historical precedent. Rome's denarius, initially 95% silver, was diluted to just 5% to fund endless wars, leading to hyperinflation and the eventual demand for payment only in gold. Spain defaulted 4 times in the 1500s, crushing its economy under a debt-to-GDP ratio of 60%, a figure that is actually better than the 120% the United States faces today. And finally, Great Britain suspended the gold standard during World War I to print money for the war effort, ceding its financial throne to the US dollar at the Bretton Woods Conference in 1944. The US dollar was pegged to gold at $35 an ounce until President Nixon took it off the gold standard in 1971 to fund the Vietnam War and massive welfare programs. Since then, the dollar has lost over 90% of its purchasing power, and gold now trades at over $4,300 an ounce. History repeated itself for the United States, just as it did for every empire before. The core lesson is this: currencies collapse, but wealth only transfers. With the U.S. national debt at $38 trillion and central banks like China buying gold at record paces, the writing is on the wall. The smart money understands that you must own assets, not promises. The dollar is a promise. Quality stocks, real estate, gold, and digital assets like Bitcoin and Ethereum are real assets that are outside of the traditional fiat system. This is why, even as we see the stock market surge, the strategic investor must position capital in ways that protect against currency collapse. This week's rally is a chance to sell promises for things that hold true value. I am personally looking at Rigetti Computing, a small market capitalization company in the foundational quantum computing space, as a key opportunity. They are the picks and shovels for the next 40 years of innovation, much like NVIDIA was for artificial intelligence. I purchased 3 shares in the portfolio to show you that pullbacks, like the one Meta experienced, are buying opportunities, not reasons to panic. Meta is an $800 stock easy, and any weakness is a chance to build a position. This rally is a crucial time to sell the promise of the dollar and buy the reality of assets. Charlotte Mloud opened our discussion, noting the massive recent run-up in gold prices, followed by the current necessary pullback. The core question every investor is asking right now is, how low can gold possibly go in this current correction? To answer this, we turn directly to the charts, where the story is told with precision. Predicting all-time highs is always difficult, especially when you can only rely on indicators like Fibonacci extensions that project forward. Our previous target for gold was around $4,400, which the market came very close to hitting. Now we are in the middle of a beautiful decisive sell-off and pullback, a period that is actually exciting for serious investors and speculators. Why? Because you make money when the chart radically goes up, or when you are able to buy on a sharp, healthy dip. To establish the potential low targets, we ran a Fibonacci retracement from the last major run-up, taking the low point from late August to the high point near $4,400. The retracement levels act as critical support areas on the way down. We have already sliced through the 38.2% retracement level. While not super strong on its own, it paved the way for the next key levels, the 50% retracement and the statistically strongest level, the 61.8% retracement. My eye is currently locked on the 61.8% target, which sits right around $3,750. I also expect gold to at least hit the 50-day moving average, which is a key technical level. But the $3,750 target is confirmed by a secondary pattern visible on the hourly chart, a bear flag formation. A bear flag has a pole, the sharp drop, and then a sideways flagging pattern. When you take a measured target of the pole and project it down from the point where the price breaks the bottom trend line of the flag, the target is calculated to be around $3,720. This $3,720 price lines up almost perfectly with the 61.8% Fibonacci retracement. Therefore, the expectation is more downside, and it is likely we will spend at least a month, possibly longer, in this consolidation period before setting new all-time highs. I would be genuinely surprised if we rocketed back up immediately. This correction is natural, healthy, and necessary after the market made an enormous amount of money very quickly. Speculators took their profits, and the market needs to work that off. Now, if I could write the ultimate script, I would love to see a washout sale in gold that drops the price to around $3,500. Why that number? Because $3,500 is exactly where the dark blue 200-day moving average currently sits. This 200-day moving average is one of the most widely watched technical indicators on the planet, and a bounce off this line would be a definitive back-up-the-truck moment for long-term investors. It would act as a powerful springboard for much, much higher prices, setting the stage for a new, extended leg up in this gold bull market. If gold just bounces from here, we might top out around $5,000 or $5,500. But if we get that washout sale and a bounce off the 200-day moving average, it could catapult prices far beyond those numbers, accelerating what I believe is only the fourth inning of this historic gold bull market. Fundamentally, I see zero fiscal restraint from global governments. They are still printing and spending money like drunken sailors. Unless they fundamentally change course, which I see no evidence of, the long-term bet on gold remains absolutely secure. Some viewers are concerned that the run is over, but that simply is not what the charts and the macro environment suggest. The Federal Reserve is widely expected to cut rates soon, and they are not doing that because the economy is healthy. They are doing it because they see significant trouble on the horizon. This economic trouble often forces a final liquidity crisis sell-off in precious metals, but that sell-off only serves to establish the final powerful base. I believe the floor in gold is probably around $3,300. I do not expect to see that price ever again, but the ideal buying opportunity is at the 200-day moving average. Just like its older sibling gold, silver has followed a similar pattern, a massive run-up, followed by a necessary and technical pullback. We applied the same analytical method to the silver chart, running a Fibonacci retracement from the last major low to the most recent high. The retracement levels remain the same: 38.2%, 50%, 61.8%, and 78.6%. Today, the price is hitting directly on the 50% retracement level, which sits around $45.50. However, the technical analysis suggests there is still more downside to come before this consolidation is complete. On the 2-hour chart, we see a crucial pattern that confirms this expectation. 2 successive bear flags. The initial bear flag consisting of a sharp price drop, or the pole, followed by sideways action played out perfectly. When we took the measured downside target of that first flag, it hit almost precisely to form the pole for a second, immediate bear flag. We now have the confirmed breakdown from the second flag's sideways action. Measuring the potential downside target of this second bear flag places the price around $43.44. This $43.44 target aligns almost perfectly with the 61.8% Fibonacci retracement level, which is the strongest technical support level. For silver, the 61.8% retracement is at $43.50. The absolute lowest technical support is the 78.6% retracement at approximately $40.65. I expect silver will see this consolidation, this period of boredom, last for at least a month or more. I do not expect silver to rocket up to new highs anytime soon. I believe the true long-term floor for silver is now around $35 an ounce. I do not think we will ever see that price again. The key takeaway is that people are simply taking profits after an amazing run, and this is healthy. This pause allows the market to reset and prepare for the next more powerful leg up. The investor's playbook. Timing your buys. The charts are not just for prediction, they are for execution. The fundamentals tell you what to invest in. The precious metals story is about government debt and currency debasement. The technical charts tell you when to buy and when to sell. If you have an itchy trigger finger and feel compelled to buy a silver miner or a silver exchange traded fund, or ETF, right now, you must scale into your position. For instance, the SELJ ETF for silver miners hit the rising 50-day moving average yesterday and is showing a slight bounce. If you were planning to commit $1,000 to this position, only bet $100 now. This is a small bet because the probability is high that you will get a better, cheaper entry point later. You wait for the technical indicators to align. You look at the Relative Strength Index, or RSI, a momentum oscillator that tells you when an asset is oversold or overbought. When the RSI is at 30 or below, it signals an oversold market and is an opportunity to buy. Conversely, when the RSI climbs above 70, that should trigger alarm bells that it's time to take some profits. Another crucial signal is volume. Look at the volume bars on the chart of PSLV, the Physical Silver Trust. When the price was low and nobody cared, the volume was low, say 3 million shares a day. As the price surged, volume increased dramatically to 80 million shares a day, indicating massive buying interest. However, when the price goes up but the volume starts to die out, that is a powerful indicator that the buyers are running out of steam, and a reversal is coming. This technical discipline is how you time your entry points during a long bull market. You take the profits you gained on the way up and patiently wait to roll them right back in when the technicals low, RSI, low MACD, and a bounce off a key moving average tell you the correction is likely over. During these inevitable pullbacks and consolidation periods, time is money. You do not want your capital just sitting on the sideline earning a 4% yield from a treasury that is being destroyed by the true rate of inflation. This is the time to rotate that capital into the next unloved sector that is just beginning its move. This inevitable consolidation in gold and silver is not a sign to sit on your hands. It is a critical signal to rotate capital into the next unloved sectors that are fundamentally poised for growth. We are actively looking for the new picks and shovels assets that are absolutely essential to the future economy and are backed by irresistible geopolitical forces and government support. The uranium catalyst uranium is a sector that is on the move, driven by the inescapable reality that the United States has the biggest nuclear reactor fleet on the planet, but is critically dependent on foreign supply for conversion and enrichment, especially from Russia. That supply line from Russia is on a fast-approaching 2-year deadline. The U.S. administration has no choice but to throw money at the problem to secure its own domestic supply chain. We saw this in action with the massive deal involving Cameco to build out new nuclear capacity. The uranium spot price is sitting at $77 per unit, while the term price for contracts a year out is already at $81, signaling a clear expectation of higher prices. While the Sprott Physical Uranium Trust, or SRUF, which is an easy way to play the physical metal, did not quite hit the desired 200-day moving average for a perfect entry, the fundamental news is now driving the price. We saw strong technical bounces in the Uranium Miners ETF, URNM, and URJ off their respective 50-day moving averages just before the major subsidy news hit, indicating a technical base was already forming. There are no immediate buys right now because the price has spiked, but you must be ready to enter on the next healthy pullback to the rising 50-day moving average. The geopolitical edge of rare earths. The most compelling opportunity for rotation right now is in rare earths and strategic metals. This sector is fundamentally driven by geopolitics. For decades, China effectively captured 90% of the world's rare earths market by subsidizing its miners and refiners and ignoring the massive environmental hazards of processing these metals. This made their supply cheap, causing the United States and the rest of the First World to become completely reliant on Beijing. Why do we care? Because you cannot manufacture a smartphone, a computer, a global positioning system satellite, or crucial military hardware like Tomahawk missiles and fighter jets without these materials. China now holds the economic and military stranglehold on these essential components. Even if President Trump and President Xi meet on Thursday and announce a temporary truce on trade, that deal does not solve the underlying systemic problem of reliance. China still has its finger on the cutoff switch. As investors, we make money by finding non-Chinese rare earth projects with low capital costs and quick build times that the US government will inevitably subsidize for national security. I am making my first entry point buy into the REMCTF, which is a basket of rare earth miners. This allows the individual investor to bet on the entire sector's growth without the risk of picking a single company that might fail to get a subsidy. The chart shows a perfect little double bottom right on a critical support line. It is underneath a rising 50-day moving average, which indicates a coiled spring ready to move. My recommended strategy is to scale in, place a 15% bet now, a 35% bet on a pullback to the $62.50 level, and the remaining 50% on a deep drop to the $55 level. The moment everyone in the market thinks the rare earths bet is off due to a temporary trade truce, that is exactly the moment you must strike with conviction. Other unloved contenders beyond uranium and rare earths, two other extremely hated sectors are showing potential. Oil. The WTI chart is showing weakness, and the XLE Energy ETF is an easy play, with key limit lines to watch at $87.25, $84.50, and $81.50. Nickel. This chart is the epitome of boredom of flatline since its spike in February 2022. Commodities are cyclical, and this period of complete boredom is often the ideal time for the patient, long-term investor to establish a position before the inevitable cycle turns. Ultimately, the best strategy is always based on patience and a clear thesis. Write out a short thesis, a couple of sentences for why you own an asset like gold or copper, and include a clear, objective reason for when you would sell. This fundamental basis, paired with the timing from the technical charts, is the professional playbook for navigating the transfer of wealth that every collapsing empire creates. Wealth does not disappear, it just transfers. The time to position yourself is now.